I've put together a quick piece to talk about more globally what's going on in developed EM and some markets that we're interested in. I'd like to keep this as short as possible. I do so much better in Q&A than I do talking at someone. And so having a room full of CFAs would be more interesting to be asked questions by, in my opinion. So I'm going to get through this quickly, and we're going to kind of get into, we're going to talk about the US Fed tapering and improving balance of trade, talking about Japan, and then emerging markets, where the stress is and where we're focused, which is Argentina. And then I'll conclude and get into Q&A and talk about anything you guys would like to talk about. With the US, something that I find to be really interesting, and I'm sure it's very topical on anyone's mind today, is this idea that we're going to taper right down to zero by the end of this year and maybe sooner. I think Yellen's got herself into a difficult situation. I think that when you look at the manner in which the benefits, the extended unemployment benefits dropped at the end of December from 99 weeks to 26 weeks back to where it used to be. I think it's going to drop off about 1.4 million people into kind of never land, off the rolls, looking for a job. And historically in the US, when people dropped off the back of the 26-week unemployment benefits, about a third of them found a job, and about 2/3 of them kind of ended up in the service business or are not staying away from being gainfully employed full-time. So today, I actually think that might be a little bit different. I actually think the ratio will be worse and not better. But what Yellen is going to face, I think as soon as maybe June or July, if you look at the construct of the way US unemployment, the way U3 is calculated, I think you're going to see unemployment at 5.5 in July, maybe June even. So you're going to see this really quick denominator effect with unemployment getting to what the Fed deems to be full employment, and yet economic activity won't be following commensurately. Let's say nominal growth of 4.5%, 5% isn't going to be happening, and she is going to be forced, I think, to either blink or taper really quickly and start raising the Fed funds rate, which I think will be a complete disaster if she ends up tapering to zero and raising Fed funds, really contracting monetary policy. I think tapering itself, when you think about the construct of the US fiscal deficit and how much we are quantitatively easing today, I think about the way that QE is working is you're running a fiscal deficit of, let's say this year, maybe 700 billion, maybe 4% of GDP. And that's basically, those are new dollars that need to be found somewhere. So far, the Fed's been buying them all. And in fact, with a fiscal deficit contracting from $1.1 trillion to 650 billion, or whatever the number is going to be, you could argue that the QE in place today is actually more aggressive than it was a year ago or 2 years ago because of that differential between running a big fiscal deficit and the difference that QE is buying on top of that. That's additional capital entering the system. I think it becomes contractionary when QE comes inside of the fiscal deficit. So that's really in the next, if they do 10 billion a month, the next 2 times will be inside of the fiscal deficit, and I think it will be contractionary at that point in time. Tapering to zero is going to be a real problem, I think, for the forward curve. And then this idea that neutrality is somewhere around 4.5% on the Fed funds rate, when each point is going to cost fiscally about 150 billion in interest, I don't see how, given the floating rate nature of the loans around the world and how we kind of went to zero interest rate policy to avoid a painful restructuring, we can't afford to raise the Fed funds rate. I don't believe we can. We might be able to go forward with kind of a ceremonial 25 or 50. We may even be able to go 100 basis points, but we're not going back to 4% on the Fed funds rate. We can't afford it. So I think understanding where we are, I think that we kind of have a pretty nice runway going into June or July, and then some really difficult decisions are going to have to be made by Yellen. She's going to have to distance herself from this target of 5.5% unemployment, or for that matter, 6.5% unemployment. It's clear that unemployment shouldn't be the target, and she's going to have to really change the rhetoric of the Fed between now and then, and I think that's what you'll see her focus on. Something that's been very positive that's happened in the US, and I'm sure you've had other people talk about this, but basically the shale revolution has not only made us the Saudi Arabia of natural gas, but look what it's done for crude production. You know, we saw crude production turnaround, really 2007-ish. It bottomed out just around 5 million barrels a day. Today we're producing almost 8.5 million barrels a day. We've increased our crude oil production here in the US and lessened our dependency on imports. If you look at the bottom right chart here, we're only importing a little bit more than 4.5 million barrels a day. We were importing almost 14 million barrels a day at the peak in 2006. So think about the balance of trade. Our balance of trade is getting dramatically better while we're tapering, while our forward curve is steepening, and I want to think about this in the terms that we at our firm think about it. That's one subset. That's 50% of an equation when I'm talking about dollar-yen. Everything that's going on with the dollar is telling you the dollar is actually going to be stronger for the next few years. I think that that our crude oil production, if you talk to the various expert friends of mine that happen to run big private equity firms in energy or invest only in energy, they think that the production peak of the crude oil shale generation is going to be sometime mid-2018. So I think we have a few years of an improving balance of trade from a perspective of hydrocarbon production. And I think that that has a dramatic effect on the rest of the world. The rest of the world has been used to us supplying them with a lot of dollars every year. And so we're going to supply them with less and less dollars at a point in time in which our forward curve is going to be steepening more, given the problems that Yellen's going to be facing with the state unemployment numbers. So what I'm kind of trying to tell you is, for the next few years, the dollar is actually going to be pretty strong vis-a-vis some other currencies. We'll get into Japan. This is the kind of the other half of the primary equation that we're focused on in G7 currencies, which is dollar-yen. If you come away from this speech learning anything, this chart should mean something to you. For the first time in 34 years, you're going to see Japan print its first current account deficit. That is a structural problem. When you think about the way the current accounts, the construct of the current account, you have the income account, the capital account, and the balance of trade. So what has kept them somewhat afloat for the last few years as things have worsened in Japan has been the income account. The income from abroad and foreign sources has actually overwhelmed that of the capital account and the balance of trade. So what you're seeing now is a secular shift. Abenomics is starting to work. Two things are happening. First of all, the balance of trade is horrible and worsening because of their nuclear situation with their nukes turned off. And they have, as you know, Japan has no natural resources. They have to import just about everything. You need to think about them as like a contract manufacturer. And they have very thin margins on their GDP. So when you look at the current account being structurally negative, think about what's going on in Japan. Their QE is twice what ours is for an economy that is 1/3 the size. So they are QEing 2 times as much as we are, and on a relative basis, when you're thinking about currency cross rates, that's very meaningful for dollar-yen. And it's only going to get worse or better, however you look at it. What's going to go on between now and April or May is the BOJ is going to actually have to buy more bonds. I got invited over to meet with Kuroda and Nakaso at the BOJ a couple of quarters ago. I thought they were going to kill me when they invited me into the BOJ. And at the end, we actually had about a 2.5 conversation about what needs to happen going forward with regard to their idea, because they've created their own paradox. If you have a country and a nation that has internal ownership of JGBs, and it's primarily institutional, right? 96% or 97% of the bonds are held internally, and 95% of the 96 is held institutionally. So if the institutional ownership base is the GPIF, the largest pension fund in the world, Japan Post Bank, the largest depository institution in the world, and Lifecos and other private and public pensions, I think that if you're trying to convince the populace and the investment populace in Japan that you can achieve 2% CPI inflation, what you're telling them is this 10-year or 30-year JGB that you have that has a nominal rate of 67 basis points is probably the wrong thing to have in your portfolio. So you create a paradox. If the investors believe that you will achieve 2% CPI inflation, what will they rationally do? Well, they will sell down their JGBs. What did Professor Ito from Tokyo University say when commissioned by Abe and Kuroda to decide what the asset allocation for GPIF should be going forward? Well, he suggested an immediate reduction in JGB ownership, 600, 800 basis points. Well, 600, 800 basis points of $1.5 trillion is a lot. And so you have a country that's running a fiscal deficit of 10% of GDP, or roughly 50 trillion yen. Their bond buying program, if you remember their shock and awe campaign announced last year, was 60 trillion yen of bonds they're going to buy 2 years in a row. They're going to effectively double the monetary base in 2 years. And that is their plan to aggressively end. This is the first arrow is aggressive fiscal policy. The second arrow is aggressive monetary policy. And the third arrow, we don't even know what that is because they're probably not even going to do it. But monetary policy alone has changed the situation in Japan so far with CPI. When you see the fact that they can buy 60 trillion yen and they have to monetize 50 trillion yen just for the deficit, the plan's not large enough. It's not even close. So the more people believe in Abenomics, the more investors in Japan believe in Abenomics, the larger the QE program has to be, because the GPIF's going to be forced to sell bonds. The banks are going to sell bonds. I met with the 5 largest bank owners of JGBs, and each one of them in a private meeting told me that they were selling 5 to 17% of their JGBs that quarter, and that they were ahead of everyone else and no one else was doing it, and they were thinking, they were forward thinkers, and that they were just ahead of the curve. And that's what each guy told me as I met with them. So I think that the QE program will have to be dramatically expanded come April or May, maybe even March sometime. So when you think about what's going on, they're running a structural current account deficit, which is yen weakening for the first time ever. When you think back to 97, 98, when you had, I can't remember his name now, when Rubin and the current Japan finance minister intentionally weakened the yen from, call it, 85, 90 up to 150 to give them a reprieve through the Asian financial crisis. It was into a current account surplus of like 5 or 6% of GDP. Of course it was going to strengthen back down. This time you have the central bank wanting to generate 2% CPI inflation, which means, you get on the back of the envelope, if you're trying to generate CPI inflation and 16% of your GDP is imports, well, you just need the yen at 118 by the end of this year, and you're going to get inflation. You're going to get the bad kind. It's going to be cost push, but you can do it. So if that's, in fact, what you're trying to generate, what you're going to see is larger BOJ JGB purchases. You're going to see a current account deficit that's structural going forward. Everything I'm telling you is yen weakening. There is no structural bid for the yen anymore. The only time that you're seeing a bid for the yen is in this, I think the EM sell-off. All of a sudden, the yen's a flight to perceived quality again. It's that Pavlovian response. Investors say, what's weak and what's liquid? We need to buy that. And that will change over time. So those will be opportunities where I think you can build a larger dollar-yen position. But I think by the end of the year, you're going to see the yen north of 115. I think you're going to see a persistent structural current account deficit due to demographics and due to the construct of their import-export balance. And the thing that you saw in November and December, which was fascinating to me, this is also part of the paradox. If you convince corporations in Japan to take some cash and actually invest it in machinery and equipment, where does the cash come from? Well, it comes from the banks. It comes from the capital account. Well, that happened in November and December. All of a sudden, the corporations started investing in kind of serious CapEx investing in machinery and equipment. Again, part of the paradox. What is that money that's sitting in the bank? What does that own today? Well, it owns short-term JGBs. The banks own it all. So if you have all of a sudden the capital account flip and corporations start taking some of the cash to spend, that's also very yen weakening. It's also JGB problematic for the BOJ. So the BOJ is going to have to buy a lot more bonds, a lot more than they've stated. And you're not seeing anyone really articulate that in research. People are talking about the fact that they might have to buy a little more, but when you put the numbers on paper, they're going to have to buy a lot more. They might have to double the current plan, which is going to be incredibly yen weakening. So you have aggregate debt monetization. This is my team put this together. I'm gonna kind of skip over something. But when you look at what's up there now, real yields. Again, when you think about they achieved 1.2% CPI inflation through, again, just really aggressive monetary and fiscal policy alone. You see the top chart, and then you see the 10-year real differential JPY USD overlay. You see that Real rates in the US are still nominally positive at roughly 1.5%. Real rates in Japan are now -1 and probably going lower. Again, imagine if you own an instrument that has a 9 to 15-year duration in your portfolio and it's paying you 65 basis points in nominal yield. There isn't a more negatively convex instrument you can put in your portfolio. There isn't one. And if what they're telling you is they will get to 2% CPI inflation, you should just sell that piece of paper. And you should buy something else. You should buy Japanese stocks maybe, because that's what's working. So the paradox that the BOJ faces is they're going to end up owning all the bonds if Abenomics is successful. And the question that we all must ask ourselves is, when that tree falls in the woods, does anybody hear it? Does what's going on with the BOJ and the extreme monetization of debt, does it affect their rates marketplace? Some Krugman would say it never will. I think that for 2,000 years it's happened just about every time. I'm not very good at predicting when, but I'll tell you that at some point in time, they're going to lose control of rates. Until then, what's going to happen is the valve is going to be the currency. I know emerging markets are something that is very much on people's minds. And I think, China is such an enigma to everyone. Clearly, no one believes the numbers that they put out. But what you're seeing is social financing, kind of their wealth management products marketplace, the non-bank lending that's going on in China. To put this into context, social financing grew about 17 trillion won last year, and their GDP grew at about 4.9 trillion won. So what's happening is financing is growing at a rate that's 3 times in GDP, and you're just seeing the diminishing marginal utility of their credit markets expanding with a serious deceleration in the nominal GDP of China. What that means is, we joke around in our office and we say, the new way to think about it is a rolling loan gathers no loss. And in China, you have this scenario where the central bank urged the banks, or commanded the banks probably, to expand bank assets 50% of GDP 3 years in a row. Imagine if the US banking system lent 150% of GDP into the US economy in 3 years. I'd take the over on 8% GDP growth for all you wanted to bet, right? And unfortunately, you're starting to see their GDP numbers come way down. And if you see their export numbers aren't jiving with their trading partners' import numbers, so something isn't really working there. So if you follow industrial metals, copper, iron ore, it's clear that China's slowing down. And when China slows down, a couple of other markets really slow down. What you saw in the rest of the EM world, really what you saw is countries that run dual deficits. They're running fiscal and current account deficits, and those that had dwindling FX reserves. So if you're running a fiscal deficit and a current account deficit, you better have a big stack of FX reserves to defend your currency. And what you saw the market attack as the US continued to taper and people were pulling out of EM. Another kind of joke we make in the office is the highway into EM, is 10 lanes wide and running smoothly, and the highway out is a goat trail. It's a single lane, and somehow you have to figure out how to get out of EM when everyone wants out. And that's what happened, in January and early February. What happened in Turkey? What happened in Brazil? What happened in Argentina? What happened in any of the nations that you saw, South Africa, that were having real troubles? They were dual deficit nations. Now, then they're differentiators. Brazil has more money than they can pole vault over to defend their currency. Argentina doesn't. Turkey doesn't. India does have a lot of FX reserves. So clearly, once they all sold off, the ones that had much better positions from an FX reserve perspective are going to do much better than those that don't. But one of the reasons why we have Brazilian inflation up here is we own Brazilian. We own the Brazilian Jan 17, so we call it. We own basically their 2-year forwards, or let's call it their government debt, because we think China's slowing down at such a pace that Brazil, if you saw their third quarter, they had GDP contract in the third quarter for the first time since 2009. And if you see their forward curve against the Selic rate has a couple hundred basis points of actual rate hikes built in to the curve when Brazilian GDP is rolling. So I think there's a lot of convexity into kind of owning Brazilian bonds, receiving Brazilian rates, which we're doing. We receive New Zealand, Australia, Brazil, anything that is kind of one of the primary trading partners or kind of tangential economies to China is something that's really interesting because the world's worried about inflation. And what's happening in these economies is things are hooking down because China's not doing very well. So again, when the world believes that, all of a sudden you'll see the forward curve trade on top of the current spot rates for forwards, and I think you'll make a lot of money, or at least we'll make some. When we get into Argentina, I know some of you have heard me talk about Argentina. I think it's the most interesting place in the world to invest for the next 3 to 5 years. I'll paint you the picture today, and as you probably know, it's absolutely awful today. You have a leader that's unfit to lead. You have a country that has severe capital controls up. You have an onshore rate of currency that is very far apart from the offshore rate of currency. It's call it 8 to 11.5, 12. You have a country that has a real problem with its balance of trade with hydrocarbons, and it's only worsening. It's completely inelastic from a perspective of its demand and need to import hydrocarbons. So I can paint you this whole picture and tell you they're in a dispute from their holdout creditors from their 2001 their 2001 default. As you know, Paul Singer and NML and Aurelius have been suing Argentina now for years, trying to get them to pay them par on their holdout bonds. So that's going to the Supreme Court. It's a mess. Argentina is a complete disaster. They have roughly 30% plus inflation. You're going to see another 25, 30% devaluation of the currency when the onshore rate finally meets the offshore rate. And again, you have leadership that is unfit and to govern. Why do I think it's interesting? Well, when you look at the rest of the world and you look at debt to GDP of these various countries, and you know how much trouble some of these other countries were in, you have Greece, which is going to see an official sector write-down. So the Troika is actually about to take a write-down on their loans. Greece is still 150% sovereign debt to GDP after the public debt holders already took an 80-cent write-down. So they already wrote off 80 cents of their public debt. This is essentially their official sector debt. And Greek 10-years trade at 7.5%. Irish 10-years trade at 3.3%. Ireland took 50% of its GDP, created this institution called NAMA, the bad bank. They took all their bad loans and threw it in the bad bank. And in all the calculations on debt to GDP in Ireland, NAMA doesn't exist. It's 50% of GDP, right? So Portugal, again, you look at Argentina, 38% debt to GDP. They spend 1% a year servicing their debt, 6% of central government tax revenue. They have a willingness and a capacity to pay. These bonds trade at 64 cents on the dollar, the euro discount bonds. They trade at a 13.5% yield. You know what Argentina would save if they restructured or basically repudiated the debt from their exchange offer in 2001? They'd save like 1% of GDP. And you know what it would cost them? It would cost them everything. They haven't been able to access the capital markets since 2001. They won't be able to access the capital markets for another decade if they restructure the exchange bondholders again. So I think you have this interesting scenario where Kirchner is out. This presidential, she served her term limit. She's out in October 2015. They have found one of the most prolific hydrocarbon resources in the world in the Vaca Muerta region of Argentina. And we are sending our best and brightest there from both service and exploration to try to partner with YPF and teach them how to pull these hydrocarbons out of the ground. So the one place where they have a real deficiency in their balance of trade is hydrocarbons. They are a very natural resource rich country run by a crazy woman that's out in October. And now you have a scenario where either Massa or Scioli takes over in October. You have probably 200 to 300 billion of FDI going into Vaca Muerta in the next 5 to 7 years. So you have, from a capital account perspective, you have huge FDI going in. If you have anyone there that's pro-business that takes over, I think you're going to see a dramatic change in the direction of Argentina. It will not be fixed. It won't be fixed for a long time. And maybe it'll never be fixed. But I can tell you that their balance of trade will begin to strengthen over the next 3 to 5 years. And you'll see the trajectory of their hydrocarbon pools start to work. You'll see new leadership. The lawsuit with NML and Aurelius will either be won or settled in the next 12 months. So if you follow the Supreme Court, since the petition for cert wasn't granted by January 15th, it won't be argued and heard until the next cycle, which would be October, if they grant cert, and which I think they will. And then it'll be decided, I think, in December or January of next year. Whether they win the suit against Singer, which I think they'll have a great chance of winning. For those of you that follow this closely, Paul Clement will file this petition for cert sometime between now and Monday afternoon. Paul used to be our lawyer. We introduced him in Argentina and recused ourselves, and they hired him. I think he's the best in the business, and I think that they have a really good chance at beating Singer in the Supreme Court under, we won't get into the legal argument unless you want to, but even if Argentina loses in the Supreme Court, what happens? Well, they'll end up settling with Singer. And once they settle with Singer, however they do that, they'll probably settle with bonds and not cash. It's a new ballgame. All of a sudden, if you followed what Argentina did just yesterday, they decided to recalculate or come up with a new benchmark methodology for calculating inflation. The IMF has censured Argentina for underreporting inflation. They've been reporting 10, and it's really 25, and recently it's probably closer to 40. They reported a number that annualized at about 44% yesterday. Now, they didn't go back and retroactively tell you that they had been reporting it erroneously. They just said that the new benchmark calculates very differently, and they don't have a great data set for 2013, and we're just going to look forward, which is probably the right thing. That's the party line. But that's probably what they're going to do going forward. If they pay their Paris Club debts, which they've engaged in the first negotiations, and they get back into the better graces of the IMF, you don't have to do these burn down analyses of FX reserves. You know, they've been burning FX reserves to hold their peg, and all of a sudden, you're not going to have to burn it down anymore. You're going to say, maybe they'll have access to global capital markets again. If that happens, these bonds that are trading on a 13.5% yield will trade on a, I don't know, pick a number. You think 9% yield would be in the right neighborhood? Do you think 8? If they trade at 8, they go to par from 63, and you get paid 13% while you wait. That is a huge return. And you don't have to worry that much about peso devaluation because they have dollar bonds and euro bonds. So I think, I kind of went over all these things here. I think that you're going to see Argentina prosper, but you're going to have to look out 3 to 5 years. And I know in today's world, you want to know what they're going to do tomorrow and next month, and we get paid once a year, and we want to know what's going to happen this year. If you have the foresight, and if you have the duration in your capital balance to invest for a longer period of time, I don't know where the bonds are going to trade between now and call it once all of this is settled, but I can tell you 2 years from now, these bonds will be par bid, and they're trading at 63. It's a huge 64. It's a huge opportunity. So that's it. Circling the world as fast as I can and where we think is functionally relevant. I'm happy to take any questions on any of the things I talked about.
Well, actually, you did touch on the do you have an opinion about Bitcoin?
You're going to find this to be crazy. I don't. Oh, sorry. The question is, do I have an opinion about Bitcoin? I don't understand exactly how they're formed, and I've read about it as much as I can. I'm not a technical expert, and I know it's another currency. I think gold's another currency. I think anything like that is, but I have no expertise in Bitcoin. Therefore, I've dedicated none of my time to messing with it. Nor will I ever have any of my net worth in something that's as amorphous as that. Well, so the question is, is there more to come? Have these currencies found a home? And if you look at the various kind of worst offenders, like the Turkeys and the South African rands, and they've actually had a period of time in which things have gotten a little bit better. In Argentina's case, it's going to get worse before it gets better, right? As long as the onshore rate is 8-ish and the offshore rate's 11.5, 12, wherever that is, As long as that exists, if those two, until those converge, it's going to get worse. So if Argentina were to just lift and free float today, it's conjecture as to where it would trade. I personally think that those numbers will converge around 10.5. But 8 to 10.5 is another really big devaluation. Argentina is facing labor and educational union pay talks today for wages. I thought it was actually a bad idea for them to print the 44 annualized number right as you go into wage negotiations, because I know they're going to try to bid the teachers, and I know they're going to bid them roughly 25 and settle around 30. Giving the other side all the ammo before you go into a duel is not a good idea, but I guess they had to. I think that I think the idiosyncrasies. I think the market just correlated to one in January, as it always seems to do, and now things are playing out. I think Brazil has a ton of FX reserves. Their economy is going to slow down. I think eventually their rates will come down and their currency will actually strengthen a bit. So again, each country needs to be looked at idiosyncratically as to what they have. And the three most important determinants are, right, the fiscal, the current account, and then the FX balance. Because when you look at the Asian financial crisis of 97 and 98, what you saw was a balance of payments explosion, right? You saw them immediately running current account deficits of mid-single digits, but then all of a sudden the FX reserves went to zero and they blew apart. And that's what happened in that's what happened in Thailand, that's what happened in Malaysia, that's what happened in 97, 98. And that's why the IMF is quick to act these days, because in theory their charter is to help small countries with balance of payments problems, and they impose austerity and they fix the primary problem. The primary surplus is what they get them to. But in these other cases where maybe that's untenable and impossible, it's going to get worse before it gets better. I don't know if I answered that question great.
Question, the Asian crisis that we had back in the 90s, is there an area in the gold line today, is there currency or events that happen today, possibly that signal another type of crisis?
I think when you look at the way global settlements work of currencies, what I was telling you about the dollar really meaningfully strengthening between now and 2018, if I'm right about that, again, the sucking sound between dollar and other EM is going to be tough. And if you're a dual deficit country and money's leaving and not coming in, you're going to have a real problem. Well, will the IMF be there to solve your problem? That's one thing. And if the IMF isn't, that's another. So do I think we're going to see another serious contagion like 97, 98? No, I don't.
Well, what would be the currency that would touch it off? What would be the advantage? What should we be looking for?
Well, I think the yen's going to weaken a lot, right? And look at what happened in Asia, again, in 97, 98. The yen meaningfully weakened, and yen deposits across the various Asian EMs, the ASEAN nations, were pulled, and that exacerbated the crisis in the various Asian regions. I think if you see disruptive movements, right, nonlinear disruptive currency movements, it's a problem. And I think the saving grace we have now is I think all of the central bankers are well aware of this, and they're trying to protect against disorderly movement. What happened in Argentina that day in January where they just said, let it float, let it go 16% in a day? I don't know who did that. And I can't figure out who's advising them. But she's fired everyone that doesn't agree with her. So she's got literally a 26-year-old kid running things over there who doesn't have any experience. So no, I'm not trying to, there are plenty of 26-year-old kids smarter than I am, but I think they shouldn't be running central bank policy. And so it's a problem, I think, from the perspective of how you think about the world. I actually have a lot of comfort in the fact that that we're not going to see something like 97, 98.
Can you talk about the Chinese debt bubble and ways that could play out in winners and losers?
The questions, the Chinese debt bubble and the way that can play out. Look, I honestly don't have an idea as to, so when you look at total debt to GDP in China, so when you look at government debt, wealth management products, social financing, and corporate debt, we think it's about 360% of GDP. That's pretty high, but it's about where the U.S. is in its totality. Could and will the Chinese add another turn of GDP to bank assets to avoid not only a painful recession and debt bubble burst, but with 5% GDP growth comes regime change. So if you're Xi Jinping and you know your days are numbered unless you just dial it up again, I think they can throw another turn on it. And that's a big number. And I'm giving you, my view from the extreme cheap seats. We don't invest in China. But looking at the numbers, and you look at their output vis-a-vis their input, you look at their import and export data versus all their trading partners' import and export data, and the numbers don't foot. China is slowing down much faster than people think it is. And that's why you're seeing iron ore prices hit what they're hitting. And that's why you see, look, one of the potential butterfly effects for China is Canada. Everyone thinks Canada is a nation that is let's say, extremely prudent in their lending practices, and that it is very natural resource rich and doesn't carry many debts. Canadian household debt to income is now 100%. It's higher than the US. Canadian home prices are now on a median 9 times median income. Does anybody know where US housing prices got as a percentage of median home price to median income at the height of the subprime bubble? It hit 7, right? Where Canadian housing sits today is completely unsustainable. The question is, if China slows down, what happens to the resource areas of Canada? One's mining, right, and one's energy. If you look at the forward curve for energy, the crude curve is so backwardated that, I don't know, all of the prescriptions for a problem in Canadian housing are out there. We're starting to see inventories build very rapidly. And when you look at these equations, the way the brokers put them out, they give you months of inventory. Well, right, there are 2 variables there, right? There's first the inventory, and then number 2 is the velocity. So you can't look at that one ratio of months. I think you need to look at the aggregate inventory and then how long it's taking you to sell them. It sure looks to me like all of a sudden Canada's literally coming to a halt. So volumes are drying up. 9 times median income is the median home price. I don't know when Canadian housing breaks, but if we're right about China, in the next 12 months, it's going to be a real problem. And there are similar scenarios to the US housing problem that exist in Canada. They're not all the same, but there are some similarities that are worth paying attention to. So if you're looking at Canada, I would advise you to be extremely cautious.
You didn't mention
sorry.
the Europe and the EU. Switched out by with all these other problems you're mentioning.
Yeah.
China, I don't know.
I think we're going to be it for a long time. But he who has the biggest blue water navy rules the world, and we still do.
Well, exactly.
So I think we'll become less relevant as other GDPs grow. But I still think we'll be the reserve currency. Europe. Here's what you need to focus on in Europe. One thing. The US banking system going into our crisis had $1 trillion of equity and about $16 trillion of assets on balance sheet. Throughout the financial crisis, we invested $882 billion of preferred and common equity into our banks. We essentially recapitalized our whole system. Europe, their banks are 3.5 times more levered than ours, and they haven't recapped anything. The UK banks have, the rest of Europe hasn't. So for those of you that think European GDP is going to turn, unemployment's going to be a little better, the world's going to pull Europe up, and it's time to plow money into Europe or buy these distressed assets coming out of the banks in a trickle, I would advise you to proceed with caution. Because the ECB is going to take over it's going to be the provincial regulator of European banks beginning this November. So today, they're actually conducting these tests, this AQR, Asset Quality Review. It's going on right now. There's some interesting things happening with that. The market seems to think that the capital hole from the AQR, the consensus is that they're going to need about $60 billion worth of equity. Now, I just told you, we injected $822 billion into a banking system that was 1/3 as levered as theirs, and they think the AQR is going to somehow magically come up with $60 billion. The guy that was the chief of staff for Trichet became the chief of staff for Draghi, and he just quit. and I have some friends that know him pretty well. I think he quit for a reason. And I think that the AQR, to be meaningful, and for the ECB, if you were taking over the regulatory burden and also the capital burden of a banking system as the ECB institutionally, what would you do? Would you want to clear the slate? Would you want to see huge amounts of private capital injected into a system that had been lying to everyone for the last 3 or 4 years? We all know that they do, but they have to, right? So I actually think the AQR number is going to be really big, and it's going to scare people. But that's going to come sometime in early summer. I think it'll come in May, June timeframe for a November implementation. And for those of you that follow the logical progression of capital injection into European banks, the way that the system's been built, it's private capital. Then you cram down the subordinated debt holders, but that requires the institution to be into an insolvency proceeding. I don't think they'll push these institutions into insolvency proceedings. So private capital, cram down of subs, national governments, then the ECB. That's the line of progression of kind of who's on the hook for European bank capital. Well, we know national governments don't have any money. And we know that they're not going to cram down subs. So bank equity. So any of you that own European bank equity, be really careful between now and May. Because think about what happens if they require 200 billion of capital injections across the European banking system. Those bank prices, the equity prices are going to get decimated. We are short all of the European banks as kind of a hedge in our portfolio against our US long positions. And we just doubled that short position yesterday. So this is very topical. And it's really a hedge against what we're doing in the US. But I think in both cases we can win. I think our US investments will do fine, and I think Europe's going to do poorly. So Europe, it's a great question. We don't have any other real investments in Europe except Vodafone. And that's event-driven. And I think SoftBank and AT&T get into a bidding war for Vodafone in the next few months. Shad. How are you? I can hardly wait for this one. Yeah, it does. I've been to the cultural capital. Sorry, the question is, do we think about the culture of the countries that we're developing theses on as part of the investment process and then part of the implementation process, and how we think about, I guess, game theorying how the events might play out based upon their cultural preferences or desires. And I think that, or their proclivities. The answer is I do. But I also think that that plays a role in letting the problem get to where it is today. I think it played a huge role. So look, they spend 50%, that's 50% of central government tax revenue on debt service annually, right? The US spends less than 10. Moody's says if you spend more than 10, you're a problem country. I think that their cultural proclivities, their inability to admit when they're wrong, and when they do, you know what they do next. You know, once they finally come clean what they did something wrong, they don't live very much longer. I think that has a lot to do with kind of the setup of the situation. The better question, that is a good question, but we've thought about this extensively. The question boils down to, and we surveyed 1,000 Japanese investors and asked them this very question because I think it's important. To the extent that let's say you as an investor own bonds in Japan on a 68 basis point nominal yield, if interest rates were to move up 100 basis points and you were to lose 9%, let's say effective duration is 9, right? You'd lose more than 10 years of your potential nominal interest payments. Would that empower you to buy more bonds, knowing that your government is in trouble? Would you, out of your national tendency would you want to, out of your patriotic duty, invest more in your bonds, or what would you do? And the answer to that question from 1,009 Japanese investors was 8% said that they would invest more to help their country, and 80% said they would run, not walk. Right? So your question is, does a cultural norm or proclivity supersede that of basic human nature, which the first inalienable right of basic human nature is self-preservation? Clearly, they have kamikazes, and that was a very small portion of the Japanese military complex. But we all know that the first inalienable right of human nature is self-preservation. If and when this happens, I will promise you that human nature will supersede that of cultural bias, and that's my opinion. They're telling me it's time now, so Shad, you get the last one. Thank you very much.